McDonald's has been in the news recently after agreeing to a 1.3 billion euro settlement with France over a 10-year period of alleged tax evasion. The case accuses McDonald's of routing profits through Luxembourg to take advantage of lower taxes, a practice known as transfer pricing, which is illegal in France. In this video, we'll explore the concept of transfer pricing and why it is illegal in France, as well as details of the settlement between McDonald's and the French government. We'll also discuss the implications of this settlement and how it might influence future taxation policies. McDonald's Tax Story. McDonald's, one of the world's biggest fast food chains and a household name, has recently agreed to pay France 1.3 billion euros in order to settle a case accusing the company of tax evasion over a 10-year period. Tax evasion is a serious offense, and the fine imposed on McDonald's reflects the gravity of the situation. The company is being accused of avoiding taxes on profits made in France and of transferring funds offshore to reduce its tax liability. The case began in 2011 when French fiscal authorities launched an investigation into McDonald's tax practices. The inquiry revealed that McDonald's had failed to declare profits between 2009 and 2019, resulting in the company avoiding more than 1.3 billion euros in taxes. In response, France's financial minister, Bruno Le Maire, said that McDonald's had evaded taxes in an unacceptable way, and it was his duty to protect the public interest and ensure that the company pays its fair share of taxes. The situation. Tax avoidance is an endemic problem in many countries, but the case against McDonald's in France is particularly egregious. It has been alleged that McDonald's avoided paying taxes in France by routing profits through Luxembourg. This is a practice known as transfer pricing and is illegal in France. Transfer pricing is a tactic whereby a company shifts profits to a low-tax jurisdiction by transferring its assets, such as intellectual property, to a subsidiary in a country with lower tax rates. This allows companies to minimize their tax burden by reducing their taxable income. In the case of McDonald's, the company allegedly moved money from its French operations to its Luxembourg subsidiaries, thereby avoiding paying taxes in France. The French government is accusing McDonald's of using distorted transfer pricing to avoid paying an estimated 300 million euros in taxes from 2009 to 2013. The French government has filed a lawsuit against McDonald's seeking 1.12 billion euros in back taxes, plus penalties and interest. This case serves as a warning to other multinational corporations who seek to avoid paying taxes in France. The French government has indicated that it will not tolerate the use of transfer pricing to avoid taxes and will pursue any such case vigorously. The use of transfer pricing to tax avoidance has been a hot issue in Europe for some time now. The European Commission has been investigating companies such as Apple, Google, and Amazon for engaging in these activities. The investigation of McDonald's serves as a reminder that companies who attempt to avoid taxes through transfer pricing will be held accountable. Transfer pricing concept explained. Transfer pricing is an important concept in international business, as it helps to ensure that companies, regardless of geographical location, pay the correct amount of taxes. Meanwhile, the arm's length principle is a key component of transfer pricing, and it is essential for any company engaging in international transactions to understand this concept. The arm's length principle is based on the idea that when two parties enter into a transaction, such as a sale of goods or services, they should do so on the same terms that would be available if they were dealing with an independent third party. This means that the parties should not have any special relationship or arrangement that would result in any one party being given an advantage over the other. The principle is important to transfer pricing because it prevents companies from artificially inflating or deflating the price of goods or services to manipulate their tax liabilities. For example, let's say that a company in the United States sells goods to a company in the Netherlands. In order to ensure that the price a Dutch company pays is fair, the US company must follow the arm's length principle and charge the same price it would charge an independent third party. This ensures that the company is not taking advantage of the special relationship between the two companies to inflate the price of the goods. In practice, transfer pricing usage shifts profits between division or subsidiaries of the same company. Another example, a company based in the United States might use transfer pricing to move profits to its division in Canada, where the corporate tax rate is lower. Transfer pricing distortion and usage frequently manipulate the profits of a company, move profits from countries with high taxes to countries with lower taxes, and also to shift profits from one division to another. This will artificially reduce the tax burden on a company, and it is illegal in many countries. The European Commission has been cracking down on transfer pricing by multinational companies in recent years. This is part of their effort to promote fair taxation and prevent companies from avoiding their obligations to pay taxes in the countries where they operate. Transfer pricing is a complex topic, and companies should take great care to ensure they are in compliance with all relevant laws when engaging in this practice. Companies should also be aware that transfer pricing is illegal in many countries, and they could be subject to fines or other penalties if they are found to be engaging in this practice without fulfilling the correct prevailing regulations. Why this is an illegal practice in France and all over the world? When a company artificially inflating or deflating the prices of goods and services when transferring them between different entities within a company such as subsidiaries or branches, this shall trigger an illegal flagging in France and all over the world. This is because the practice gives companies an unfair advantage over other businesses and individuals who pay taxes in the same country. Seen as unfair, as it gives companies an unfair advantage over them. If companies are able to transfer goods or services at artificially low prices between related entities, then they are able to reduce their taxable income. This in turn reduces the amount of tax paid, which can have a detrimental effect on the country's economy and revenue. In France, distorted transfer pricing has been prohibited since 2002, when the French government adopted the arm's length principle. This principle states that prices for goods or services must be determined independently, as if the two companies involved were unrelated. This means that any transfer between two related entities must be made at the same price that would be charged in an open market. In addition, transfer pricing can also be used to hide profits and avoid paying taxes. This is especially true when companies are transferring goods and services between related entities in different countries, as they can artificially inflate the prices of goods and services in one country while deflating the prices in another. This allows companies to avoid paying taxes on their profits in one country while still being able to benefit from the income generated in another. For these reasons, transfer pricing is illegal in France and all over the world. It is seen as an unfair way of avoiding taxes and gives companies an unfair advantage over other businesses and individuals. This practice needs to be stopped in order to ensure that everyone pays their fair share of taxes and that the country's economy and revenue are not negatively affected. The settlement. The settlement between McDonald's and France has been a long-running story, but the details are finally clear. McDonald's has agreed to pay 1.3 billion euros to France to settle the long-running case against them concerning transfer pricing. This amount is equal to what they would have paid in taxes had they not used transfer pricing. This money will go to the French government and will be used for public investments and social programs in France. The settlement marks a significant victory for the French government, as it demonstrates the multinational companies can no longer move profits across borders to avoid taxes. The case also serves as a warning to other companies that have been using transfer pricing to minimize their tax bills, that such practices will no longer be tolerated. The settlement between McDonald's and France is a clear example of the power of government action when it comes to ensuring companies paying their fair share of taxes. It serves as a reminder to multinational companies that they must comply with all laws and regulations, regardless of where their profits are located. Impact for McDonald's. When McDonald's announced their settlement with France, it sent shockwaves through the industry. The settlement revealed that McDonald's has been operating in the country without proper authorization and was making millions in profits without properly paying taxes. This has not only raised eyebrows, but it has also had a significant impact on McDonald's finances. The settlement with France requires McDonald's to pay an estimated 30 million euros in fines and back taxes. This is a significant amount of money for the company to pay and could have a major effect on their bottom line for the year. The settlement also requires McDonald's to pay 500,000 euros in additional taxes over the next 5 years. These additional taxes will put a further strain on the company's finances and could force them to cut back other areas of their business. The settlement also requires McDonald's to update their tax planning and to ensure that they are properly adhering to all French tax laws. This could pose a challenge for McDonald's as they must ensure that they are in compliance with all of the new regulations. Overall, the settlement with France could have a major impact on McDonald's finances. The fines and back taxes, as well as the additional taxes and the new regulations, could significantly reduce their profits for the year. This could then have a knock-on effect on the rest of their business, as the company may have to make cuts in other areas in order to stay afloat. Eventually, the settlement with France could have a major impact on McDonald's finances, but the company is taking steps to ensure that they are compliant with the new regulations and that they are able to maintain their profits. The settlement is a reminder to other companies that they must be aware of the laws and regulations in the countries in which they operate and to take any necessary steps to ensure that they remain in compliance. Takeaways. McDonald's is the latest example of a large company facing consequences for engaging in transfer pricing. Others have also faced similar situations, including Apple and Amazon. It's important for companies to understand the risks involved and to be aware of the laws and regulations related to taxation. This case serves as a reminder that companies should be mindful of their tax obligations when operating in multiple countries. Ignoring local laws and regulations can have serious consequences, and this is something that all companies should consider when making decisions about taxes. Ultimately, McDonald's is paying a hefty sum of its actions. The 1.3 billion euro settlement is a warning to other companies, and it serves as a reminder of why it's important to be mindful of tax laws. Companies should take this case to heart and make sure that they are compliant with tax laws in all countries where they operate.